Hello, my name is Irfan Nadira. For this video, my group will discuss on MFRS 15 revenue from contract with customers. Case study 1, Yuhu Berhad and its subsidiaries. Yuhu Berhad is a widely diversified group with several subsidiaries which carry out various activities such as trading, manufacturing, contracting, property development and others. Yuhu Group adopted MFRS on 1st January 2012 when it was first implemented in Malaysia. On 1st January 2018, the group adopted MFRS 15. The following transactions are sample of those that have occurred for the financial ended 31st December 2018. One of the subsidiaries operate a trading company and a supermarket in Shah Alam, and the following transaction took place in December 2018. For A, sold 100 kg of beras wangi for a consideration of RM600. Question 1. Define contract based on MFRS 15. So the answer will be, according to MFRS 15, a contract is an agreement between two or more parties that creates enforceable right and obligation. The requirement of MFRS 15 apply to each contract that has been agreed with a customer and meet specified criteria. Contract approved, right of each party identified, payment terms identified, contract has commercial substance, and consideration will be collected. For question 2, based on the accounting standard, explain the recognition criteria applicable for recognizing revenue. At contract interception, an entity shall assess the goods or services promised in a contract with a customer and shall identify as a performance obligation in each promise to transfer to the customer either a good or service or a series of distinct goods or services. So, when to recognize the revenue? If met these criteria. First, customers simultaneously receive and consume advantage as entity perform. Second, performance create or enhance an asset that customer control. Third, performance does not create an asset with alternative use and entity has right to payment. Otherwise, point in time, an entity shall recognize revenue when or as the entity satisfy a performance obligation by transferring a promised goods or services to customer, or an asset is transferred when or as the customer obtain control of that asset.
Hi, my name is Sharifah Nati Fakihah. So I will presenting question B. So the question is, the construction arm of the group enters into a contract with the customer to construct a factory, a staff quarters and cover the car parks for 30 of the customers management and staff of the total consideration of RM4,500,000. The factory cost RM3 million, the staff quarter cost RM1 million and the car park cost RM500,000. So the question is, based on MFRS 15, when should the above revenue be recognized in the financial statement? So there are 5-step model of recognition revenue, which is the step 1 is identify the contract with a customer, which it relate with the rights and obligation, which the right can be related to the customer to get what they supposed to get as promised, and the obligation can referring to the seller which have responsibilities to perform activities. So moving on to the step 2, which is identify the performance obligation in the contract. In this case, the seller are responsible to construct a factory, a staff quarter and car parks of 30 the customers management and staff. Step 3 is determine the transaction price, which are the factory cost RM3 million, the staff quarter RM1 million and car park cost RM500,000. So step 4 is allocate the transaction price of performance obligation in the contract. The total consideration of the contract is RM 4,500,000 and the factory costs RM 3 million. The staff quarter cost RM 1 million and the car park cost RM 500,000. So the final step of the recognition revenue is recognize revenue when or as the entity satisfied of performance obligation. The performance obligation is satisfied when a promised good or service is transferred to a customer, which are to construct a factory, a staff quarter and car park for the customer management and staff.
Assalamualaikum and hi. So I will continue with next question, which is C. So I read the question. It also enters into another contract to build a retaining wall in 3 phases. Due to the nature of the terrain, there are different attributes for each phase of the wall. The contract calls for each stage to be approved by the quantity surveyor. Number 1. Based on Mfrs 15, when should the above revenue be recognized in the financial statement? So the answer is, once the contract has been agreed within you and quantity surveyor to build a retaining wall in 3 phases, the quantity surveyor will figuring out the cost to make it done. If each stage have been approved by the quantity surveyor, the contract can build a retaining wall in 3 phases. The service is distinct, which is separable than a contract with a customer to construct in B. The performance obligation is certified when the customer can get benefits when they are in the building, which a retaining wall in 3 phases make the building is safe to use. So you can recognize the revenue in the financial statement.
Hello and Assalamualaikum. My name is Nur Natasha. My question is, the Rahman Resources Group runs the Rainforest Club for members. Members can pay an entrance fee of 10,000 and monthly subscription of 200 per month to use the various facilities at the club, including the restaurant, where the food is charged separately. Alternatively, the member can pay a life membership fee of 150,000 and no further subscription are required for his lifetime membership of the club. Other payments such as food consumed in the restaurant needs to be paid. The lifetime average is 25 years. My question is, how should the entrance fee of 10,000 be recognized in the financial statement? Alright, basically the entrance fee of 10,000 can be recognized in the financial statement based on the record and asset as 10,000 plus the 200 monthly, so times 12 months, which is we get 2,400 and separately food charge of food. Each contract is inception seen at this point in time because inflow of resources which is record and asset in each of entrance fee and monthly subscription. A standard service contract separately priced service contract which is an entrance fee of 10,000 and monthly subscription of 200 per month and food charge separately. The separately priced service contract is the lifetime average 25 years. The Rahman Resources Group receive payment at the inception of the contract and recognize revenue over the term of the agreement in proportion to the cost expected to be incurred in satisfying the obligation under the contract. Generally, Rahman Resources Group also earns revenue from the provision of general ledger service. For the fixed fee arrangement, which is 200 monthly, a revenue is recognized based on the stage of completion with reference to the actual service provided under the contract. Therefore, the fee for the service contract revenue recognized up to the month of less than the group is entitled to invoice for service performance to date based on the contracted rates.
It's Rasma Hanimiti Rahmat, and the last question is, how should the life membership fees of 150,000 ringgit be accounted for under MFRS 15? And the answer is, the lifetime membership fee of RM 150,000 can be accounted under revenue from contract with customers. The amount of revenue recognized from contract with customers separately from other sources of revenue. As stated, the other payments such as food is not included. The Rahman Resources Group has determined that no significant financing component exists in respect of the general law service revenue streams. This has been determined on fee for service and fixed fee arrangement as the period between when the entity transfer a promised good or services to a customer and when the customer pay for that good or services will be 1 year or less.